Hello, this is Doug Gerlach from iClub Welcome to our Investment Club webinar. Today is Tuesday, September 20th, 2022. So we're pleased that you could join us on this last day of the summer of 2022. We're going to be talking about how successful investment clubs invest. We're going to be talking about some of the procedures and policies and strategies that clubs that outlive the test of time and perform well over the long term utilize in the operation of their investment clubs. Tonight, we'll be joined by Russell Malley and Sean Pulrang from our team, as well as Triva Dildeen is in the back office as well. You may hear from any of those if you use the questions tab to write in your question at any point during the presentation. It's part of that GoToWebinar application. You can simply click on the questions box to type in your question at any time. There's a handout for tonight's presentation that you can download in PDF format. Just click on the Handouts tab and you can save that file for future reference, print it quickly to take notes, or you can always reference it and access it when we issue the video of tonight's presentation. Which will be on our YouTube channel as well as on iClub.com in a week or so. So when we're talking about how successful investment clubs invest, this is certainly not the way that all investment clubs can invest. There are many different ways that clubs can utilize the strength of coming together in a group to make investing decisions and invest in all different types of securities. But we're going to talk about the clubs that follow the principles that, from my experience of 30 years of covering investment clubs and being a member of investment clubs and observing how investment clubs work in the creation of our tools at myiclub.com and all of the programs at iClubcentral. So this is a summation of some of the lessons that we've learned and the team has uncovered in the course of history. And as you gain experience, you can often that often gives you license to break the rules. So these guidelines, if they don't fit your particular situation, feel free to adjust them. But the core principles, we believe, are pretty firm and provide a good, strong base for your club to find success. So one of the things we learn is that successful clubs are steady. They're consistent in their investing approach. They're not scattershot. They're not buying any stock that comes along and catches their fancy. They typically will have a strong investment strategy or perhaps even a written investment policy statement that details the types of securities, the type of analysis that their members will perform on the stocks that the club will be studying. Of course, last month in our club webinar series, we covered the investment policy statement and why it's important to have it and how to put it together, so you can check out that archive in the iClubcentral channel on YouTube. We believe it's important that clubs stick to stocks. It is very problematic to invest in certain types of securities, and it can provide other problems and issues for investment clubs. So ETFs, mutual funds, royalty trusts, limited partnerships or master limited partnerships, commodities. These are some of the securities that can be troublesome for clubs, that make things more complicated, that require additional bookkeeping or accounting, that require additional adjustments to your preparation of your tax return, that might delay the return from being completed in a timely fashion. So if you stick to stocks, you'll see maximum benefits from your investing partnership. The bonus, if you stay away from these complicated securities, is your treasurer will be able to maintain his or her sanity during tax season. And once you've decided on that approach, don't stray. Be disciplined and stick to your guns. And that's not to say that you can't carve out a 5 or 10% portion of a portfolio and allocate it towards more speculative investments. And that's, again, perfectly fine as long as that portion of speculation doesn't overtake the strong fundamentals that govern the rest of your stock selection. Successful clubs also should have a healthy time frame. They should understand the long-term nature of investing in the stock market. They don't aim for short-term profits. They don't aim for a high level of turnover that creates lots of transactions and, again, lots of potential for investing or accounting complications. Successful clubs aren't concerned with short-term market gyrations. Going back in time, in Better Investing magazine, you'll see time and time again interviews with clubs going back to the 60s and 70s and these clubs that have experienced massive bear markets, and they all say the same thing. We just put our heads down, we put the money in the bank, we invested in those low priced opportunities that were being presented to us, and when the bear market ended, we reaped the giant rewards from that strategy. So taking advantage of bear markets and downturns is something that works throughout history. And it doesn't matter the nature of the cause of a particular bear market, they always resolve and go on to return impressive gains for those investors who are able to weather the storm and maintain the course and speed during those bear markets. Successful clubs should also have reasonable expectations about returns. It's very easy to get caught up in the media hype and the advertising and marketing of lots of investing products that promise very high rates of return. Keep their objectives in line with the reasonable expectations and the history of the market. The market over the long term delivers 10 to 12% a year when you're investing exclusively in stocks. That means some years the market may be up 20 or 30%, other years it may be down 20 or 30%, and in many years it's up in the 5 to 15% range, and that would be considered a very typical year for the market. If you are disappointed in the rate of return that you're earning, consider benchmarking your portfolio to the broader market indexes like the S&P 500 and see how well your club is performing against those indexes. And if you're able to match the performance of the broader market, you're doing better than 70 or 80% of professionals who are trained and who are managing mutual funds and portfolios for other individuals and institutions. Here is a graph, and you've probably seen a chart something like this. This shows the performance of $1,000 invested in small cap stocks, large cap stocks, in a balanced portfolio in government bonds and treasury bills and in inflation starting in 1920. And you can see the gray areas where we are experiencing recessions, and you can see the white areas where the economy is expanding. And at the top of this list are small cap stocks with the best performance, followed by large cap stocks. And for those who are not as interested in those exclusive sections of equities, the balanced portfolio delivers a much lower rate of return. And then those who might be interested in bonds and treasury bills, barely outpacing inflation over the long term. So just a reminder that no matter what happens in the economy, what happens in the global geopolitical situation, over the long term, stocks perform better than other assets. And trying to guess the direction of any particular asset in the short term is not likely to reap any rewards. So successful clubs stay the course. During turbulent markets, they remain fully invested. They don't try to say, oh, the market is too volatile for us, we're going to get out, we're going to move to cash. That's not something that happens. During overheated markets, they remain fully invested. Better Investing's principles over the years have led the leaders of the organization to observe that it's best to sit on your portfolio when things are pricey. Don't try to make wholesale moves to sell those securities because they can always go up. And many investors learned that in the period following the 2008 bear market. They thought the market was getting more and more expensive, but it continued along that trajectory for several years. And if you had decided that it was too expensive to be in the stock market, you would have missed a lot of gains going forward. And likewise, during depressed markets, it's good to remain fully invested. The market has already taken the decline. Don't exacerbate it by selling everything at a loss. Just sit tight, and the bulk of those companies will come back and go on to reach even greater heights. We never try to guess when the market will recover or when up markets might peak. That is a fool's errand to try to manage your portfolio to the timing of major market moves. And evidence shows that if you're out of the market during a few days of the year when those major moves happen, your returns drop precipitously. So stay the course, as successful clubs do. Of course, clubs are made up of individual members, and those clubs that are most successful have a committed membership. Their members are contributing cash on a regular basis. Those members recognize that down markets are often the best time to increase monthly payments. This has been my counsel to clubs during market corrections and downturns. This is a good time to kick in a few extra bucks each month, as long as your club's partnership agreement allows it. Increase your purchase of clubs ownership of the club during those down periods, and when the market does recover, you'll gain a little bit of extra return from it. I also believe that successful clubs know that contributing cash in meaningful amounts is really important. If everyone is chipping in $10 a month, and they are, reasonably middle class, their club portfolio is nothing more than a plaything. It's a toy. It doesn't have any meaning to them. But the minute that you put in $100 or $150 or $200 a month, then it becomes something that you pay attention to. I believe this is one of the problems that many clubs in the 2000s experience as inflation has increased the purchasing power or decreased the purchasing power of a dollar. Many clubs didn't adjust to it, and so they started off requiring $20 or $30 or $50 a month, but then 10 or 15 or 20 years later, if they're still going, yes, some of the original members have recognized some impressive gains, but new members coming along, putting in those small amounts, it just is not meaningful to their financial situation. And if something's not meaningful, then you pay less attention to it. Now, of course, every club is different. Every club will have a different strata of members at different income levels, and will need to accommodate those members. But I also believe that you should encourage those who can contribute more to contribute more. That will help the club build its portfolio faster, and it will also make sure that people are paying attention to the club's securities, its diversification, and other attributes. Members in successful clubs are committed to the club, and they demonstrate that with their wallet. Another aspect of successful clubs is they share the workload. All members participate in the club's operations. They help research companies, they present stock studies, they follow stocks in the club portfolio, they use tools like the stock selection guide. And the long-standing clubs have traditionally shown a tendency towards having all members utilize the stock selection guide by requirement, which is to say that those clubs require all their clubs members to utilize the stock selection guide, and that way everyone is on firm footing in terms of how they analyze stocks and how they make decisions. So that is definitely something that I'm a staunch advocate of, having that consistency of approach so that all members can participate according to their skill and experience. Obviously, new members are on the uptake in terms of the learning curve, and the more experienced members are leading the way. But then over time, that balance of power shifts. But everyone gets to contribute, and everyone should contribute. And beyond the research and portfolio management portion, There's also the club operations portion, the officers, the treasurer, the president. Those roles all should be shared as well. On My iClub, we have tools that allow you to assign stocks, each stock in the club's portfolio, to a stock watcher, and that provides accountability. There's no confusion, and then we have tools for the stock watchers to help them generate a report that they can use to base their report to the club on their selected stock's progress since the last time it reported earnings or the last time the stock watcher reported on it. And this is just one way that we're trying to encourage club members and clubs to make sure that it's not just a handful of people who are doing the work. The more involved all of the members are, the better for the entire club's portfolio. So successful clubs are doing the work of collecting ideas for the club's portfolio. They're studying lots of stocks in lots of industries, which it means that every meeting there will be presentations of stocks. There will be ideas. Most of those stocks are going to be rejected, maybe for valuation, maybe for diversification purposes, maybe for fundamental reasons, but every stock study that is presented to the club is a learning experience and raises the investing quotient of the club members. You can be researching industries, learning better how to understand how particular companies operate in a certain industry can be a very valuable educational experience. And besides doing the research, you should also be challenging your existing holdings regularly. Clubs that are successful understand that you can't sit around and simply wait for stocks to perform. You need to take action sometimes to replace the underperforming stocks, to replace the overvalued stocks, to replace the stocks in which the club does not have a lot of optimism about its future returns. And for instance, on My iClub, on the Portfolio Offense report, this is a report that identifies stocks that are either one, overvalued, or two, offer low projected future returns, in many cases because they have performed so well in the past that there's just not much upside left for those particular holdings. In other words, the stock has performed quite well, and investors have allowed the price to get ahead of the fundamentals. In many cases, that means that a solid company might not be a very good investment at its current price. So on the Portfolio Offense report, you can rank the companies in the club's portfolio by the projected annualized rate of total return. And if you have a stock that is paying a total return, or is expected to earn a total return annualized at 4 or 5 or 6 or 7%, you would be wise to consider replacing that company from the prospect of finding a stock that might perform with a 12, 15, 18, or 20% annualized return at some point in the future. So by constantly double checking the club's holdings, by reviewing the expected total return going forward, you can optimize the returns of your portfolio. Sometimes this seems counterintuitive. In the example here, Apple has performed very well, but the projected total return, according to this stock study, is only for a 5.5% annual return, including dividends, over the next 5 years, because it never really gets a big sell-off, even when the market corrects, perhaps. So the idea behind the offense report is to help you look at your holdings in a different light. And clubs know that if you take action instead of sitting around with being uncertain, that will work to the benefit of the club's portfolio. Successful clubs also know it's best to avoid meme stocks, those stocks that are often being touted on message boards on the internet, that are very popular but often have poor fundamentals or excessively high valuations. So those types of stocks are best left to people who aren't focused on the fundamentals. It's also best to not get distracted by the fear of missing out, FOMO. When everyone else is talking about the big gains that they made in a particular company, it's good to keep in mind that if this particular stock is not part of your strategy, you're not actually missing out on anything. Successful clubs know that investing in stocks is a marathon, not a popularity contest. So we're not chasing the popular stocks. We're investing in stocks that we believe will stand the test of time. And that's how we find opportunities and are rewarded in any market. Successful clubs should have a watch list or a wish list. This is a list of quality stocks the clubs reviewed in the past at some point, liked but didn't buy typically. This happens quite frequently, especially if you have a robust program of presenting ideas to the club. Your members should not be dissuaded from presenting a stock that seems fundamentally sound but also seems very expensive. Quality often attracts a premium in terms of price. So when that happens, move these stocks onto a watch list and then maintain that watch list and periodically review it to look for ideas for future study. And on my iClub, we have a watch list that you can utilize. Members can add securities to it. You can review the percentage return up or down since the stock was added, which can be very useful in identifying opportunities. There are also a list, a grouping of portfolio-like reports that will help you to review the fundamentals of those particular companies. Successful clubs are not afraid to sell stocks when needed. When the fundamentals are turning down and the prospects for total return in the future are reduced, those can be good sell indicators. If the future is too uncertain to support holding or buying more, then a sale can also be reviewed. Too often, investors and investment clubs sit around not knowing what to do with a stock, and as a result of that paralysis, they see the stock price simply deteriorate further right along with the fundamentals. When the valuation is too high to support future returns, or whenever you can find a new stock that promises higher returns and better quality than a stock in the current portfolio, that makes for a very valid sale discussion. Now, in many cases, there will be tax ramifications and diversification ramifications that need to be reviewed, but all of the things being equal, if you're holding a stock that has a 7 or 8 or 9% annual return expectation, and you find a stock that has a 15 or 18% annual return expectation, it can certainly make sense to consider challenging that current holding with the new stock and replacing it. The portfolio defense report on my iClub and also part of the SSG Plus tools will highlight those fundamentally underperforming stocks. They're flagged in pink. That means you need to pay attention to those values. And this will provide you with some early warning of possible future deterioration. So review this report regularly. And for those stocks that are so indicated, consider updating your analysis and making a decision about whether you want to continue to hold them in the portfolio. Successful clubs also diversify broadly. They maintain a healthy diversification of stocks with companies of all sizes, small, mid, and large. They include companies from all three super sectors, many industries. This is easy to track with the portfolio diversification reports and graphs on my iClub. And a pie chart like this gives you a quick insight into the diversification according to those various levels. You don't even have to look at the numbers to know this club has a lot of holdings in the consumer cyclical super sector and much fewer holdings in consumer defensive sector. When we're experiencing economic hard times, that would cause this portfolio potentially to not perform as well if there were a higher level of consumer defensive stocks in the portfolio. Successful clubs also know how to maintain focus. It's best not to hold more than 20 or so stocks in the portfolio. For very, very, very large portfolios that are well over $1 million, you might consider expanding that to 25 or even 30. Rule of thumb is don't hold more stocks than your members can follow regularly. Often that's 1 stock per member or 2 stocks per member. In any case, don't hold any stocks with a value below 3% of the total portfolio. If you've got a lot of stocks that are making up 1 or 2% of the club's portfolio, they're not contributing to total return in any meaningful way, yet they demand attention of the members to update them regularly. So it's best to sell those positions or add to them to bring them up to that 3% guideline. Clubs know that when you are making initial investments, they should also be substantive, close to that 3% level is a good rule of thumb. And this forces you to be focused. It forces you to take a good, strong position and to be confident in your selection. If you find your club finds itself saying, well, let's see what happens if we just buy a couple hundred shares of this particular stock. Well, we can tell you what's going to happen. Either it's going to go up significantly and you're going to wish you bought more, or it's going to go down and you're going to say it's a good thing we didn't buy more. But if you had made a commitment in the first place, you wouldn't have to be second guessing yourself later on. Maybe that would have tipped the balance and made you do that additional 10% of research to become confident in your decision. So with that, let's talk about a few tips for how successful clubs find and analyze stocks. There are often I often hear from clubs that members can't find stocks to study. They can't find anything that looks good on the stock selection guide. Here are just a few resources that you can consider. Better Investing Magazine, of course, does a lot of coverage of stocks and presents a lot of stock ideas, both from the undervalued perspective as well as from the growth perspective. There is the most active stocks in the Better Investing Magazine and also on our My iClub website. We have each month the Better My iClub Top 40 with the 40 most active buys, sells, and holds of all investment clubs. The BI First Cuts and other newsletters that they produce that provide ideas taken from Better Investing members around the country. On Stock Central, our website, we offer the roster of quality companies, which is a weekly screened list of high quality companies that look good on Section 1 and Section 2 of the stock selection guide. Often they are expensive, but that's what happens when you focus on quality. We have our new Dividend Center and an easy to use stock screener there. Our newsletters, the Investor Advisory Service and the Small Cap Informer, provide regular stock picks. The Investor Advisory Service is providing 3 stock recommendations a month since 1973, and there was never a month when they said, oh, we couldn't find anything, so there are no stock ideas this month. Nope, they were always able to find stocks to study. Morningstar Investor and Value Line provide lots of resources that you can probably find at your library or maybe even online with your library. And web stock screeners can provide that detailed drill down into the particular fundamentals that you think are most important. Our My Stock Prospector screening tool allows you to create a screen, save it, review it from month to month, and provide an updated list of stocks to study. So those are some resources that you might want to check out. The stock selection guide has been a tool used for more than 75 years, and it is well tested, going back to the earliest days of NAIC Better Investing in the 1950s, used by clubs and individual members throughout all of those years. If you are a Better Investing member, you can access the core SSG or the SSG Plus tool there, which are interactive online web applications that allow you to import data for any North American company, and you can perform the analysis there with plenty of help and a growing feature set. The advantage for club members is that you can link your SSG Plus stock studies to your My iClub portfolio reports for your investment club. There's a help guide in the file library of your club website that's got complete details on how to make this happen. And this works best when your club members are all using the tool and are all updating their stock studies on a regular basis. And this is a feature that we're very pleased with. It requires diligence on the of all members and administrators. But once it's implemented and everyone's got into the swing of it, it can be very effective in understanding how the individual companies in a club's portfolio are performing. This is the list of my assigned stocks in my club. So you can see at any point as a club member, you can log in to your club's website and you can see your assigned stocks. So this gives you the ability to not have to remember what stocks you study or you're assigned. You can simply find your list here. You can go to SSG Plus to update them. You can generate a Stock Watcher report directly from this screen. So we're not going to cover the stock selection guide principles tonight, but I will give you a short checklist for clubs and club members to consider when you're selecting and analyzing any stock. And you should only buy and hold companies if they have consistent, growing annual and recent quarterly sales, and the same for recent and annual quarterly earnings per share. This gives you the opportunity to benefit from the growth of those companies, which will drive capital appreciation, and that will be the bulk of your total return in your club portfolio in a growth approach. Growth should be appropriate for company size, so at least 7% for the largest companies in your portfolio, to as much as 15 to 20% for the smaller companies. There should be no major obstacles and plenty of tailwinds for continued future growth. This is a big part of my analysis methodology, is to consider what is driving the growth of the company and what are the things that might hold it back in the future. I want to understand those risks, and I want to understand what the factors are that will drive this company's business in the next 5 years. I find that's a very useful way of quantifying what the stock selection guide section 1 visual analysis graph displays in terms that we can really understand and you can hang your hat on. We also like to see pre-tax profit margins that are stable and growing and comparing well to peers and competitors. So that is something that requires a little extra research to find those industry averages and see how a particular company sits within its industry group. We like to invest in the best, and we got to be able to identify who are the best companies in any industry and how does our selected company compare to those. On the relative value side, this is the percentage of the stock's current PE to its average PE. We like to see stocks in that 75 to 125% range when we're buying them. You'll often find stocks have much higher relative values now, even with the market's correction, because the bull market from 2008 to 2020 drove up valuations considerably. But that's a rough guideline that I like to see. Reasonably, when you're buying stocks, the projected high PE ratio that I utilize at the high end is 30. So I like to see those stocks below that and not exceed that in my estimation of what the future may bring. On the total return side, we like to see at least 15% total return when we're buying a stock. Sometimes we'll make allowances for a high quality company to accept a slightly lower rate of return. And the assumption is that that provides a little more stability, a little less volatility in the portfolio, but we don't want to make allowances too often, or we run the risk of having our portfolio not exceed our goals. When you're holding stocks, if they are not earning a total return of at least 5%, then that can be troublesome for your overall portfolio return. And in terms of the reward to risk ratio or the upside downside ratio, it should be better than 3-to-1 when buying, or better than 1-to-1 when you're holding a stock. If the reward to risk ratio falls below 1-to-1, that means that the downside is higher than the upside, and that is the opposite of what we like to see. So this is a good slide for discussion in your club to see how the current holdings you own might fit, and how stocks you consider might also meet these various criteria on the checklist. So with that, if you have any questions, feel free to let us know in the questions box. I don't see any that have not been answered. So we will be adjourning in a couple of minutes here. Our next month's webinar will be led by Sean Polrang of our support team, and he's going to be demonstrating a brand new feature that we're releasing on My iClub that will be very useful for club treasurers. That's in our October 2022 edition of the ICLUBcentral My iClub Investment Club webinars. Well, with that, I'll say thank you to Sean and Treva and Russell in the back office. Thanks to all of you for turning out, and I wish you all the best for a happy autumn as we go forward. I'm looking for continued economic recovery and stabilization of the market as we head into the last few months of 2022. I remain optimistic about the long-term potential and continue to look for opportunities in the current valuation of the stock market. I'll just leave you with that little prognosis because I know a lot of people are concerned about where we are in the market and how things are going. But I'm pretty optimistic that we've seen the worst of inflation by and large. It may creep up a little bit, but I think we're heading into a return to a more normal period, and I hope that will come in the last quarter of the year. With that, thanks once again. We'll see you at our next Investment Club webinar.